Hi, welcome back to another edition of Lippert Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be reporting flows for the shortened Thanksgiving week ended December 4th, 2013. Maybe you'll be a little surprised if you hear that investors inject about $31 billion into the fund industry. That's conventional funds only at this point. We will talk about ETFs later on. But the reason I say that is because after we finished the week up of Thanksgiving, we actually had the Dow post an 8th consecutive upside week. Now, that was absolutely amazing. And people started thinking, this rally is getting a little long in the tooth. So over the preceding 4 days, or the 4 days after that, from Friday all the way to Wednesday again, we saw that they actually had negative performance each and every day. So we had 4 consecutive weeks downside performance. And this was on good news. The reason was, again, people were thinking, it's getting a little long in the tooth. The Fed's going to be happy with some of the numbers that came out. And can we stand that? ISM number came in, the non-family, new homes for families actually came in higher than expected, and ADP, private employment numbers came in higher than expected. And everybody started thinking maybe the Fed is actually going to have to come out and take away a little bit of that easy money, and that was some of the reasons why we saw downside performance. But nonetheless, we saw inflows again of about $31 billion. Let's see how that broke out in our macro classifications. If we take a look at equity funds, they took in a little bit under $1 billion in net new money. That's amazing considering, again, we had a meltdown of four days in a row of negative performance, both S&P and the Dow. Taxable bond funds took in, I'm going to say, a net zero. $57 million is really what they took in, but again, that could be a rounding error. Muni bond funds, so it took a 1-2 punch once again, losing about $900 million. And then on the big inflow side, money market funds took in about $30.9 billion. We'll talk a little bit more of that as we get going. Let's take a look at what we did as far as equity funds. The equity fund story was we actually had a downside return for the week, 0.16%. We lost. It's the second week in 3 that we've seen negative returns in this group. $891 million of net new money came into the coffers. Not a lot to talk about, again, but we're getting close to that $1 billion mark. It's the 8th consecutive week, though, that we've seen inflows into this group. Domestic equity funds took in about $144 million, not too much, but it's their 8th consecutive week also of taking in money. But kind of the big attractor has been international. And non-domestic funds took in $777 million this week. It's the 27th consecutive week that they've actually seen inflows as well. Now, we break that down a little bit. We might want to take a look at who was the big winner. Large cap, on the domestic side, large cap funds, people were looking a little bit for safety, I think. Again, we had good numbers. People weren't going to go out online and buy the Russell 2000. So we saw large cap funds taking just $272 million, but that was the largest inflows that we saw for that group. Non-domestic side, we saw international equity funds, again, taking pretty good money, about $581 million in net new money. And of that, we could actually attribute about $154 million to emerging market funds. So, it's been a little bit low on the money coming in, but it's kind of been the same characters that we've seen during this kind of trying time of what the Fed is going to do type of moments. Let's take a look at what happened, though, in the equity ETF arena. That certainly was a little bit different. We did see the conservativeness come out here. It's the 3rd consecutive week we've actually seen inflows. They took in only about $594 million, not a whole bunch to talk about. But what we saw, though, is, again, we saw some good numbers coming out on the NASDAQ, about the funds like Power Shares, QQQ. So basically, we know that money came into that, about $700 million in that group. iShares MSCI EFA took in about $600 million. And then we saw SPY, kind of a conservative play again, losing about $500 million. Taking about $500 million. But with iShare 2000, this is where people are walking away from the risk factor. $1.6 billion in outflows. So certainly that was kind of the story that we were seeing as far as inflows and outflows into the equity ETF arena. Now, keep in mind, those two together, they really did go in tandem together. So we didn't see any surprising flows for the domestic side or the conventional fund business side versus the ETF side. Let's take a look, though, what happened in the fixed income universe and see what was up there. For the 2nd consecutive week, we saw inflows. It's only about $57 million, like I said earlier. It's the first week in 3, though, that we've seen negative performance, down 0.27%. And the group that took in the largest amount of money was corporate investment grade debt funds. Now, it's not too unusual. It's kind of where kind of the safe haven play where people have been going. $458 million net new money into that. But of that, We saw money, $355 million going to LoanPar. Now, I believe that's where the story is. People are still just reallocating from this portfolio group, putting money back to work in a different way rather than pulling money out and putting it into equities, as a lot of people have thought. So we're seeing this week after week. So loan participation, that adjustable rate group actually took most of the traction, took most of the money in for that group. Now, where we saw them losing, where do you think? Long end of the curve and in govies. So we saw government mortgages lose about $241 million. We saw Treasury mortgages, Treasury end mortgages lose about $149 million, so really that was kind of the story as well. Longer dated treasuries were getting thrown away. Loan participation funds, short duration products were actually taking the money. Let's see what happened on the ETF side for this group. $315 million of outflow. $315 million of outflow. It's the 5th consecutive week that they've seen outflows. And by the way, when we take a look at it, iShares short treasury bond actually took in the largest share, $276 million. We saw that authorized participants actually went out and bought the PIMCO Enhanced Short Maturity ETF. Here's that story again. Short duration products took money, $126 million for that, not a whole bunch. But if we take a look at the iShares 7 to 10 Treasury, that's where the big money got thrown out, $208 million taken out of that. So really we can kind of see some separation there. People again going for shorter duration products, getting rid of some of their long products. Kind of funny that we see at the bottom of that chart that just passed that we saw some loan participation funds actually losing some money, but of course we're going to have some offs and ons as people get a little bit concerned that maybe that rally in its 77th week is a little bit long in the tooth as well for loan participation. Let's take a look at our last group. That's muni bond funds. Muni bond funds, again, lost about $900 million, 28th consecutive week that they've seen outflows. This is the 2nd consecutive week we've seen negative performance, down 0.14%, so not a lot. But keep in mind, we're hearing news about some agreements from the Detroit bankruptcy filing. People are still very concerned about Puerto Rico debt, so really people are still not comfortable yet on jumping back into those muni bond funds. We saw national munis lose about $609 million during the week, so that certainly was the story there. Our very last group we'll talk about is money market funds. People did decide to sit on the sidelines. This is the 3rd consecutive week that we've seen inflows. This is one of the largest in the 3 weeks. $30.9 billion coming into their coffers. Taxable money market funds took in $28 billion of that. Tax-exempt money market funds actually had some good money come in as well, about $2.9 billion. But when we take a look at the taxable money market side, we saw that $27.7 billion was injected by institutional shareholders, and about $300 million came in via the retail investor, not institutional class. So when we take a look at it, we see that people were concerned, and I don't think they're running for cover. I think what they're doing is saying, we're going to put money back in the market. Let's let it sit there. Let's see what happened with the Fed and what they're talking about. And probably the biggest number that we were waiting for came out this morning. It was non-farm payrolls, certainly followed the ADP payroll index numbers, with actually adding 203 million people, 203,000 people from their non-farm payroll rolls. So that was a big number, and we actually had some rally in the market today, and I wonder when people are going to wake up and say, yeah, but now the Fed might start cutting, and we might see some more outflows out of equities because of the good news. Good news, folks, is good news. I don't think that we should be treating good news as bad news, but anyways, we'll see what the market does going forward. If you want to take a deeper dive in some of the areas that you want to focus on in the fund industry, you can go to our website at www.lipperusfundflows.com, or you can join us next week when one of our analysts will be talking to you. I don't think I'll see you until after the holidays are gone, so I'd like to wish you happy holidays coming up and a pleasant new year, and we'll see you soon. Thanks for joining. My name's Tom Rosine. Have a nice day.